next panel, I'd like to begin by inviting Merlin Biscitelli to come up and join us here on stage. Merlin is a senior director for EMEA at Merrill DataSite. We're very pleased to have what is evolving into a global relationship with Merrill DataSite and the development of thought leadership. They've been tremendous contributors and collaborators with us in both our publishing and the forums that allow us to bring you all together. And so I thought it most fitting, Merlin, for you to kick off this next panel, where we will have the opportunity to listen to both strategic and private equity investors about what they see as the outlook.
Welcome, everybody, and thank you for taking the time out of your busy schedules to join the first M&A Advisor Symposium and Deal Makers Awards here in London. We have been a proud sponsor of this event for a number of years in New York, and we are very happy to see it come over to London, and I'm sure we'll see the same levels of success and rising attendance each year that they do this in the future. As you mentioned, my name is Merlin Biscitelli. I'm the Director of International DataSite, so I oversee our business outside of Americas. As some of you may know, and I know a lot of the people here on the panel do know, we are the market-leading due diligence platform, and it has been a spectacular year for us so far. We have broken records month after month in terms of new projects that have been loaded onto DataSite, as well as the amount of data that's been put onto our system. This has been buoyed really by a strong IPO market, especially leading up until really the last couple of weeks, and then continued open high-yield markets, as well as a very robust M&A climate. Now, these are all subjects to change. As we've seen the increased volatility over the last couple of weeks, we've seen a number of IPOs that have been pulled for various different reasons. But we feel strongly, based on our data, and we always look at these things, and we're a real leading indicator of where the markets are going. And we average somewhere in the neighborhood of about 400 new projects per month. And that's 400 new deals that are going to be coming onto the market in the near future per month. Well, in the last 2 months, starting September 1st, that has increased to close to 500 new projects that have come onto DataSite. So what that tells me really is that the M&A market has the ability to push through this volatility, because most of these projects will either be something that they're trying to get closed by the end of the year, or it's something that's going to be launched in early 2015. So I still think we have some good legs to run on the market that's here, and I think that we can manage through this volatility that we're seeing and the few IPOs that have been pulled recently. What I also wanted to say is I don't like the word VDR, virtual data room. So we're always referred to that as DataSite as a virtual data room provider. And what I look at it as, we are a due diligence platform, and what we're utilized now for is much more than just M&A. We've seen a real increase in the use cases of DataSite for things such as fundraising, portfolio management, investor communication, document repository, contracts management, where companies and law firms are suggesting to their clients of utilizing DataSite to manage their contracts, to prepare them better for transactions, and to instantly react to the marketplace. IPO due diligence, high-yield due diligence, procurement processes by large organizations, as well as, obviously, M&A, which is the main backbone of our business. So with that said, I would like to thank everybody for the support of DataSite and the projects that you've given us, the interaction that we've had, and I would like to turn it over to Jeremy, who's going to introduce our panel.
Great, thanks, Merlin. I'm Jeremy Kahn. I'm a senior writer at Bloomberg Markets magazine, which is the monthly magazine that Bloomberg publishes. We've got a great panel here, so I'll just start introducing them. Immediately to my right is Charlie Johnson, who's the origination partner at ECI Partners, which he joined in 2004. Charlie is responsible for ECI's deal origination and advisory relationships. He was previously at Ernst & Young for 7 years, where he's part of the corporate restructuring team and worked very closely to develop business relationships with private equity groups. To his right is Crispin Goldsmith, who is the investment director at Duke Street and serves on the board of Payzone. Previously, he was a director at Royal Bank Equity Finance, which is the private equity arm of RBS, where he was focused on consumer and leisure and financial services sectors. Among the deals he was involved with were those involving Erno Laszlo, the premium skincare brand, and Catalina, which the non-life insurance and runoff manager. He's also a veteran of PricewaterhouseCoopers, where he worked in the corporate finance and assurance teams. Then we have Andy Dunkley. He's the CEO of the iconic clothing brand Lee Cooper Brands, best known for their denim. This business was a 2005 investment for Sun Capital Partners, and Andy joined as CEO in 2008, bringing with him significant experience as a CEO and CFO from both private equity and multinational corporate environments. He recently helped Lee Cooper's investors realize an important and significant sale to Iconics Brand Group. Andy has worked in sales, he's worked in sourcing and finance in locations that range from China to Turkey to the Philippines to South Korea, among others. And last but not least, we have Tony Dahlwood, who's the managing director at LDC. He was formerly founder, chief investment officer, and chairman at SVG Investment Managers and CEO of SVG Advisors, global private equity fund businesses with $5 billion under management. He helped lead SVG's growth across a number of different vehicle structures, including limited partnerships, OEIC, and listed investment trusts. Prior to that, Tony was a managing director at Branton Capital, and he also serves as a non-executive director at the London Pension Funds Authority. Without further ado, I guess we'll start in. Merlin mentioned the volatility we've been seeing in recent weeks and the effect that that may have on the market. My first question for the panel, and we'll reserve time, by the way, for questions, hopefully, from the audience towards the end. My first question is the volatility we're seeing, what sort of challenge and opportunity does this present from an investor standpoint? I know several of the panelists think that there might be an opportunity here for investors. Maybe we can start with Charlie Johnson and then go from there.
And then the other piece about the volatility which we're not seeing is we're not seeing a huge amount of withdrawn deals. And we track all the deals we put offers on, whether they're withdrawn or not. That peaked at 50% in 2009, and it's now down at 0. Deals are getting closed. And I think that's a reflection of the amount of money in the marketplace and lack of opportunity, as much as the quality of the opportunities. But we haven't seen this current volatility actually also causing withdrawn deals.
Kristen, what was your sense of this?
Yeah, I mean, the interesting point on the public markets earlier in the year was not just in terms of value expectations, but in terms of supply of deals to processors as well. I think, a lot of deals were going to IPOs that would have traditionally gone to processors, and equally deals that went through processes that didn't necessarily work were possibly going then to the IPO markets rather than going to a quieter bilateral deal process with a private equity institution. So I think definitely the froth, let's say, coming off the public markets, if it's sustained, is helpful. But I think we as private equity will obviously still need to pay good prices to persuade people to trade, and there's we'll probably come on to competition in the mid-market or the private equity market generally, but that's definitely still going to be a feature going forward.
All right. Andy or Tony?
From a strategic investor rather than, I don't know whether I'm the rose or these guys are the thorns, but for us it's less important on that volatility. If it's a more realistic expectation on price, then that's fantastic. But it's not really going to be something where we're looking to IPO a brand as we're already on the market.
I just think this volatility also, we should consider that valuations are significant and they drive future returns. And it possibly wakes people up to think about, well, actually, let's have a look at valuation instead of jumping on the back. It's easy to be a momentum player. It's not easy to be part of the crew. And when you step back and say, actually, let's look at things. And I was surprised, and I looked at it in the pack here. There's some really good data here from S&P. I don't mean to plug them, but there is some good data here. And if you have a look at some of the private equity exits, value to EBITDA multiples, and you can see numbers of 15, 20, 13, 12. Those are high numbers, and it's very rare that you would expect private equity to want to then say, I think I'll step up to the plate and buy things on 15 to 20 times EBITDA. And I think that's significant because it then leads you into a theme of the public markets at the moment are willing to pay those multiples, which then drives all sorts of deal flow. So I think there's a natural theme here of there being, again mentioned earlier, private equity being more sellers than buyers at the moment. And I think that's a clear theme, largely driven by the fact that there are some sort of valuation anomalies going on, where the public market's willing to pay those for various reasons, whether there's expectation of growth or whether it's cash that they need to put to work. Whereas private equity have built up deals over the last few years and have taken this window to try and exit. And particularly, they've been fortunate enough to have the valuation opportunities the public market's taken them. So the volatility will impact all sorts of things because it does unnerve public market investors. I was one for several years at Phillips & Drew PDFM. it is a nerve. You do not want to buy something at 100p, which on day one is 95 or 90p, and you will stop buying. And as a result of that, that will knock on to the IPO process. It will knock on to subsequent exit. So it has a very short-term impact. But more importantly, I do think people should look at the prospective returns from markets when you've got valuations as they are today. If you buy things on PEs of 7, 8, you should expect to generate very good returns versus if you buy things on PEs of 27 and 28. So it sounds obvious now, but people do tend to buy things when there's momentum on 27 and 28.
Right. Tony, I'm glad you mentioned valuation. That was going to be my next topic. I know that when we were speaking on the call before this panel, a lot of you said that valuations are very high, particularly on the equity side. If you look at what public markets are willing to pay, it is very pricey compared to historically. However, on sort of debt valuations, there's quite a lot of things that are still sort of attractive out there. Crispin, I think you were talking about this. Maybe we could start there and talk about not just equity valuations, but on the debt side of things. What do debt valuations look like, and are there opportunities here for investors to potentially get in on something through debt?
Well, I think, certainly one of the things that's driven valuations on the private equity side has been the availability of debt. And I think what's interesting now compared to 2006, 2007 is the market is much more driven by funds, non-bank debt providers. And so whereas, not for a moment suggesting we're in the same position, hopefully, that we were in 2007 or 2008, but whereas as that process started to arise, the banks switched off the taps on debt pretty quickly. A lot of the providers in the investment space now are funds that have raised capital and will need to deploy it. And whilst volatility may impact on their appetite to put that money to work in the short term, I would expect that appetite to come back fairly quickly. So I think that's again, that will feed into valuations going forward. So I think yes, that's been one of the key drivers of valuation, and it's also probably that shift in dynamic from banking to funds investment is probably one that will support valuations through this frothiness.
I think that's right. I think that's also quite worrying. I think coming back to what Tony was saying in terms of focusing on returns and the entry valuations. I think if you're paying a high price and you've got a high amount of leverage, it's great if you're a spreadsheet jockey and you sit there and the computer says you can do the deal. That the reality is the risk-weighted returns on a 5 times, 6 times levered deal in the lower mid market are huge, particularly if you're using a non-bank fund whose perspective is saying, look, we can lend at 5 to 6 times because at the end of the day, if we end up owning the asset at 5 to 6 times, it doesn't matter. So they've got a loan-to-own mentality, you're the equity. You are going to be in a very difficult situation. And I think across the board, too many people, too many deals are being done with very high amounts of debt because that is where people can get to. And too many people brought up on spreadsheets to do deals as opposed to understanding really how this is going to play out over a cycle. And we are in a strange cycle, aren't we? The liquidity cycle at the moment is slightly out of kilter with the economic cycle because of QE. I think it's probably a good 100 years or so since that's been the case, and not many people can remember it.
Andy, from a strategic perspective, do you worry less about valuation? I mean, valuation is probably still important.
It is, and I think there's an awful lot of potential froth coming into the marketplace that's driving some unrealistic expectations of sellers on exit. Yeah. And because of that availability from all the PE funds that are sitting there coupled with debt, we've turned down a number of deals that we just can't close that gap. And we don't want to be in a position where we're factoring in everything that we bring to the table on a deal. That would be just too much for us. So we've walked away from a number of deals in Europe just because of the unrealistic expectations in our view on price.
Just on the last thing on valuation is, I do think it is, from our point of view, we're a growth investor and we regard ourselves as a premium buyer of premium assets and hopefully get the last thing right. And therefore we're not afraid to pay some pretty punchy multiples. And in our current fund, actually, we've paid around that 13 times on 3 assets, and they will be phenomenal returns. But it is where you've got a really high premium asset with great recurring revenues, good cash conversion, good growth potential. I still think there is the opportunity to push the boat out. What we're seeing, though, is people pushing the boat out on relatively mediocre assets with not great resilient revenue, not great cash conversion, and they're a me too in the marketplace. We saw it in an FX business. Mid-market advisor Cavendish was selling, and they thought this was fantastic. A bunch of US guys had flown in. They were paying 2 to 3 times more than everyone else in the UK or European market, put the valuation up towards 13 times, and it was a high-growth business. No resilience, though, whatsoever. It's just a bunch of people on the desk making phone calls. And I think that, to me, is the challenge you've got in this current marketplace, is I don't think there's enough discretion in terms of the quality of the assets and the valuation.
I would agree, and I think what we're seeing, this volatility, as it's called out, is the public market sets benchmarks, and the volatility does shake out opportunities as a result. And what we're seeing in the public market is that when somebody doesn't hit their numbers or disappoints to any degree, there is it isn't a derating of normal proportions, and that leads to companies then therefore being good companies but have been derated back to the single-digit multiples which are attractive. Then the public markets don't work, then there's a private equity setting. So we've not seen too many public to privates. Why? Because of the valuation aspects and also the execution ability. But the valuation thing, opportunity will come down the line. It's coming.
Right.
And you can see smaller, mid-sized public companies now who have missed their numbers, not necessarily through anything dramatic, but the stock market doesn't want that. They want growth. And because the growth isn't there, they'll derate them, and then you're back down to the 4, 5, 6 times EBITDA multiples, where the opportunity to do deals and provide capital, development capital, etc., is occurring. That's beginning to be seen. You can see that. I'm sure that conversations that weren't there a year ago are now trickling into ECI. They're certainly trickling into Lloyd's, LDC, and so I think that's a real aspect of the next 12 or 24 months, I think.
And that missing of the earnings in the public markets, I still find extraordinary. You know, someone says we're going to grow at 25%, and you grow 2 quarters at 20%. That's still bloody good. You know, and you get killed for it because mismanaging expectations.
And, well, I think you're now going to fantastic philosophical glass of wine discussion, but that's where you know, the public markets who proclaim to be long term just aren't. And you know, in the last 20 years, we used to talk about public market pension fund investment for 5+ years. Well, you just don't get mandates on 5+ years now. And whilst people talk about, yes, I'm out a long-term mandate, they then ask, literally in the same breath, how did you do last quarter? And, of course, that's not a private equity discussion, but it is a public market discussion. And as a result of that, people get driven, hedge funds have helped drive that to a short-termism, which is back to the point, that's why disappointment at any level leads to dramatic derating and opportunities.
If I could just add as well, I mean, I think, you're absolutely right. You can get very good opportunities even at high entry multiples, so long as you're pricing the execution risk on the plan properly and the risk of potentially multiple contraction on exit. And I think, particularly the latter point, people don't always consider. But I think the other thing is, we've seen a number of processes that have fallen over where the advisor has been very vocal about trying to run a process to A, maximise price, and B, minimise time, both at the same time. And I think, in certain situations, advisors need to recognise that if they really want top dollar, they need to give people the time to get under the skin of the business and really get comfortable with the price they're paying, rather than trying to run a quick process and get a massive price at the end as well.
Right. And I reiterate that. And generally, the quality assets come down to, in each sector, it tends to vary by size and shape, but the same few people who are really hungry, credible, and understand the market and the sector. And therefore, giving those individuals more time up front to get to know the business, you're going to get a more certain outcome and probably a higher valuation. I think you're right. You know, there's too much. Throw the book wide, 150 people. And to be honest, sometimes we like that because it just destroys opportunity. It puts off people like Andy from a trade bar because they're told they've got to pay 13 times, and everyone else knows that's not going to happen. And if maybe Andy disappears from a process, sometimes the rest of us think that's all right. We know he likes it, he's been mismanaged. So we do see that a lot.
I wanted to ask a question about, in terms of outlook for the next year, which geographies you think may be most promising? UK and Europe obviously is where we are now. But when we're looking at activity from investors' point of view, which geographies do you guys think look most promising? Andy, I know on the call you said still sort of disappointed in the feeling in Europe. And when you talk to folks in Europe, it's still quite a depressed environment.
Yeah,
you could elaborate on that.
Yeah, I think if you're looking at typically where we're looking at buying a brand rather than the company, and we've bought about 30 brands over the last 10 years. If you look at a reason for sale, you look at an entrepreneur who's perhaps built up a brand or something cool in Europe that we want to take internationally. His reasons to sell are diminishing quite rapidly, actually. He's not under pressure from his bank, he's not paying high interest, he's paying a whacking big tax bill. And if you look in somewhere like Italy or France, as soon as he sells a business, he's going to have the tax inspectors going through every single penny in his bank account and asking him to justify that. So that makes it, on the reason to sell side, quite tough at the moment. So we have to be quite ingenious and come up with some different ideas to get across those brands, because we're sort of caught on the one hand, the market is not that exciting in those core markets in Europe, but on the other hand, there's some very cool brands that we want to get hold of and take internationally. So it's getting through that reason for sale, and it's really odd where we are considering, there's no sign of interest rate growth, which I would say would be another help for us in somebody having a reason to sell. So that makes it difficult, and you've got to be quite innovative to get to the right brands.
Very interesting. Tony, what are you saying?
Well, I think that, get it to long-termism and short-term, I mean, Europe is clearly differentially priced from the rest of the globe in terms of opportunity. Return on capital is much lower on average across Europe than it is across the rest of the world. So hence the opportunity to do a margin enhancement, cash flow enhancement, et cetera, is all there. And on top of that, you're not paying peak multiples like you are perhaps in other jurisdictions. However, the short-termism comes into things of the public markets, which will drive all sorts of benchmarks. So what, in my opinion, what won't disappoint over the next 12 months is where you want to be, i.e. on growth. And I think that may still be Europe, and that's the worry. So for a long-term investor, Europe is an opportunity for all sorts of reasons I've just mentioned. But I just think a lot of the UK stock market is a proxy for the global industrial marketplace, and I can just see some elements of disappointment on growth expectations, and as a result of that, I'm not really a bull on the markets in general in terms of where their ascendancy at the moment.
Who are we seeing come over? I know that there's quite a lot of U.S. corporates that have cash that is sort of stranded in other geographies because of the tax consequences of repatriating that money. And then I was talking to someone last night that said there's quite a lot of Asian investors that are keen to do deals in Europe. And if you're a PE fund and you're looking for exits, those are potential opportunities. Are you seeing that at all across your business, or what do you think? Who's going to be sort of the active players on that side? Do you think going forward?
It does depend by sector a lot. The tech sector, we still see the US buyers predominantly, and be that actually trade or PE. In the consumer sector, it tends to be more local players. Industrials, again, it's much more global, and that's where we are seeing more Asian interest. And then, if you take the sort of amorphous mass of sort of business services, it varies hugely. I think there's probably more change and opportunity there. But almost the buyer groups, and interesting enough, our investment activity as well is probably more sector dependent. If you take Europe, where we've got a business in M2M, this whole Internet of Things, and its growth in Europe is fantastic, because that's still relatively early stage. But most of our tech plays see more growth in North America than Europe. If you take, we've got something in sustainable energy. Africa's a fantastic opportunity, but you'd be pretty wary going in with other plays there. So I think you do think geography to almost specific assets, not just sectors.
Right. Well, if you had to put your sort of Swami caps on and talk about which sectors you think are going to provide the best opportunities in the next year, what would those be? I mean, Charlie, what do you think?
It was interesting. I think it was at Marshall in the last panel saying, so if you're a PE firm, you wouldn't be investing in software, which obviously we are slightly contrary to that. We like it as a business class and a business model. I think it's a fantastic business model. very high degrees of resilience. The challenge is it's very high pricing, but I still think the tech sector is interesting. You can get in at a reasonable price. And then it comes down to niches. It's interesting, the brand and consumer, there's a real opportunity across Europe, isn't there, with brands to take them overseas. The challenge is getting in at a valuation and unlocking those, and if you can, there's great opportunity. And I touched on the sustainable energy piece. I think there's a lot to go for there.
Okay, Chris, what do you think?
Yeah, I mean, I think it's interesting actually. A number of messages have come out about the fact that there are challenges in most sectors, and the sectors that there are fewer challenges, the challenge is price. I think for us, we try to identify the sectors which aren't hot. It probably applies to everybody, but we're taking things much more on a case by case basis, I guess. Looking at subsectors, looking at business within those subsectors. We've spent a lot of time looking at healthcare. We closed a deal over the summer, which was in a relatively unloved sector, but we were able to get it at a price that we found attractive. That's still an area that we're spending a lot of time on. Financial services, I think, is a relatively uncovered area within private equity. I think, interestingly, a number of funds are starting to dip their toes into it, and that possibly reflects competition they're feeling in their more common sectors. But again, it's not. Whilst there are areas that we like, we like consumer finance, we like wealth management and so on. But again, they aren't necessarily the easiest sectors to deploy capital into, and you need to take it on a cautious and case-by-case basis. I think, particularly when you talk about the macro environment that we've been talking about, and although the UK economy's been performing well, I think questions as to how real that's been and to how sustainable it is. So I think, I guess for me it would be very much a case-by-case basis rather than picking
sectors that you think
Yeah.
are going to perform,
Yeah.
and going out and finding something in that. It's more, see what you can find, and on a case by case examine the company. Makes sense. And Andy, I know you're focused, a specific area that's going to match strategically with the brand, but what are you seeing in that area, in that sector?
Well,
in terms of
I
activity?
think one of the things, we want a brand. We've traditionally been in sports, entertainment, and lifestyle.
Right.
We think our business model is going to go into some new sectors. We think there's some strong brands in different areas. I've looked at some completely different deals that we think with a really good brand that is in different areas. And that will be the main focus that we've got, and see if we can pull off one of those deals in the near future, which will be quite innovative, we think, and show how the brand model goes into different areas as well as the traditional consumer good thinking.
And Tony?
Difficult to add too much more. Crispin says it's a bottom-up process. It's where the opportunities are, and if you can try and get things off market out of process, then so great. When you look at that, the S&P thing again, where there may be valuation opportunities, healthcare appears to be, although that number in there is 20 times EBITDA doesn't reflect what I'm seeing. And support services, business services, where there are still low, sort of mid 7-8 times single-digit EBITDA multiples, again, very attractive for long-term opportunities, as long as you can then get a management team and a business that can grow. So difficult to say anything on a thematic basis, but a bottom-up basis, those are some ideas.
Okay, I want to allow some time for questions. So one thing I knew we'd said on the call we'd ask about is the UK obviously has an election coming up next year, which could have a significant effect on outlook for investors here in the UK. And I hate to plug a competitor, though. Janen Ganesh, I don't know if anyone saw it in the FT yesterday, had a great column, the thrust of which was to try to kind of get Brits to be a little bit less down on themselves. But towards the end of that, he sort of put the choice offered in this election very well, I thought. He said it was easy to imagine the next government doing something seriously stupid in order to meet the national mood. And he juxtaposed Ed Miliband, who wants not just to raise taxes, but potentially to unpick the liberal economic model, with David Cameron, who he said was 2/3 of his way towards stumbling out of the UK out of the EU without ever intending to have done so. So I want to go down the panel here and say, what do you think the next election might bring, and what are the opportunities and challenges that could present for private equity investors?
I reckon there's going to be a coalition, and it most likely to be a blue-led coalition, and depending who they partner with. One of the biggest challenges, it's going to be the uncertainty leading up to it, and then the uncertainty leading up to the EU referendum, which will put a pause on investment, and generally that's a bad thing.
Yeah.
So I think we will see more challenging headwinds in the local economy.
Crispin?
Yeah, I think I think it was in this building that David Cameron gave his commitment to a referendum, and I think he's kind of moving to, whereas when he gave that commitment, he was clear that he wanted the UK to stay in Europe. He's now kind of being less explicit about that for party political reasons, and I think we're in an interesting dynamic that can only lead to uncertainty for the next 6 months. That, probably an outright right win for the Conservatives isn't necessarily a great result for business because of the uncertainty over Europe as a result. An outright win for Labour, I think, would be alarming, both from a taxation point of view, but also, like you said, what it means for kind of the wider economic outlook. So I think in the short term, it creates risk, it creates uncertainty. Obviously, in terms of investment, anything to do with anything reliant on government spending is going to be challenging. I think, in the longer term, hopefully, once depending on what the outcome is, we can then kind of reassess and go from there.
Andy?
Gut feel, I think we're heading for a hung parliament, that's for sure. Yeah. I would probably go, my vote would be, or my prediction would be rather, Labour and Liberals. And I think that's going to be the worst of both coming out with a really heavy tax agenda, which is really the wrong time in the cycle to be doing this. You look at the size of the deficit, which is going up rather than down. There's some key issues, and I think Labour will be there with a go tax everybody to get this down, which in the end will be negative on the cycle. So I see a lot of downside coming next year.
And just maybe you could talk a little bit, Tony, about how everyone says there's uncertainty, how you manage that uncertainty.
Goodness, that's a tough one. But I wasn't going to predict the election. I just think, I think the elephant in the room will be the independent EU situation. And we just take what happened with Scotland and how the whole of Scotland and the discussion around Scotland just stopped everything. Companies decided to think about how they could get out of Scotland and repatriate, and then others were thinking about how they could deal with it on a political agenda. It just became a whole all-consuming thing in the lead up. If you were involved in it and just watching it from the sidelines, well, that's what, in my opinion, will happen with the UK, because it will be a close vote for some bizarre reason, and the implications are clearly larger and more significant for the world economy, or certainly European economy, than if Scotland leaves the UK. So I think that will just be the elephant in the room, and a lot of debate and a lot of worries and a lot of people thinking about moving jurisdictions, and all of that will lead to significant instability and volatility and worries and concerns for possibly 18 months, certainly 6 to 12 months lead up to it. And I think we're all pretty educated here, but when we talk about in-out vote, well, what does that mean? And, in like France and Germany, in the EMU, or out, or, I don't know what it means, right? So if I don't know, it's going to be pretty worrying for the average voter. Right. And I worry that the wrong result may happen as a result of that. Right. And that's why I just think it's a major issue as it leads up to the election, and then will become the major issue both financially and politically afterwards.
Right. Let's take some questions from the floor. Who has questions? Anyone have any questions for the panel? Let's see. Anybody? Is there anyone with questions? Somebody must. Nobody's raising their hand. Well, we could always go. Oh, there's somebody with a question. There we go. Let's wait for the mic. Hang on a second.
Hello. I'm curious what new sectors Andy is thinking of going into. He sort of tempted us with a throwaway remark. Perhaps you could enlarge on that.
If you look at our model, it's really a very asset-light model where we buy the intellectual property, we focus on the marketing of a brand, and we allow somebody else to do the heavy lifting, the operation, the investing in working capital, and we think that unlocks a lot of the value of the brand. Now, if you look at brands and consumer brands, we've operated in the fashion, entertainment and sports sector. I'm keen to get much more into home and apply even some technology brands we could be taking into and get something quite innovative and different and apply that model again. And I think we'll be increasingly looking at that, because the business model, in our view, works. It does a lot of growth. We unlock a lot of brand value. We also unlock for our partners a lot of operations value, bringing them great brands that they can use in their markets and leverage their skills. So I think we have no limits on the areas that we can go into, and a lot of opportunities coming from different areas like that.
Great. Any other questions? Anyone else prompt anyone to think of it? Can't quite see over here, but I think we're question right in front. There we go. You can wait.
Yeah, is this on?
It is.
There we go.
Yep.
Yeah, I'm Steve Miller, and I come from the U.S. In the U.S., all the rage these days is shareholder activism, driving changes in corporate behavior. It's much less a factor here in Europe. Do you think it's going to make a difference? Are you glad that the activists stayed over on the other side?
I'll say, I've been involved in a few activist situations. I've led one or two. There is a very different culture in the America's activism to here. Buying 1% stakes in American companies and then jumping up and down and rattling the cage is norm. It's not the case over here, where people will take block stakes. Recent one, Electra and Ed Bramson, who is an American, naturalised, haven't been British. But normally it's to take a block stake and then do something, or it's an activist who owns 5-10%, and then he will get the Schroders, the Fidelities, the Threadneedles on side behind closed doors in order to do something. You do get the old activists in the papers, but it's rare relative to the US. So there's a very different culture. Back in the mid-2000s, the Americans did come over. They're the steel partners of this world, the value acts. They did come over. They've retrenched, I think, really. I haven't seen them in the last 5 years or so. And I suspect as valuations in America are higher than they are in Europe, you might see them turn their attention prospectively to Europe because of the valuation opportunity and the opportunity to unlock value. So I think naturally, having been here, gone back because of all sorts of reasons, it wouldn't surprise to see them back over here. And we've seen one, as I say, with Ed Bramson and trying to do Electra, which wasn't successful a couple of weeks ago.
I thought that Electra situation was fascinating, wasn't it? Because ultimately, I can't remember what he bought. It was less than 10%, wasn't it?
He's got 20.
Is he 20? Okay. Well, if he is interested in changing the direction and strategy of the business, buy it. Okay? If or club together with majority shareholders to change direction. If you're a minority shareholder, why should you dictate to the other 80%? And we saw it with one of our investors. They had a minority on. They changed the strategy, got out of investing in private equity. Their private equity investments will be their best returns out of the cycle, but some minority active investor changed the strategy at the board. Should the board have been stronger, etc. But I don't know. If you want to change its direction, buy the business.
Well, that's a cultural difference, I think, between the UK and the US. And I know there's a panel later today on activism specifically, so stay tuned for that. Any other questions? We have a few more minutes, actually. Yeah, there we go. Great. Keep your hand up so you can see where you are there. Okay.
Hi, yeah, thanks a lot for really good insight. So my question is pretty much about risk. I mean, you talk a lot about, the uncertainty, and only last week we could see the sell-off and sort of the panic that could cause this. So are you prepared for it in a way, for this uncertainty? So if we were going back to probably not 2008, but if there was a massive sell-off, if the rates moved, and it is going to massively impact your returns, are you doing something about it? Do you consider yourself prepared for it, or do you hatch? Do you manage it? So how you manage sort of extreme volatility or sort of tail risk?
Well, I think that's more of a public markets thing, and I think that starts at your asset allocation decision. Really, where do you think markets are in the valuation cycle? I think I've laid my cards on the table, which is that I'm not a bull of returns from here from equities, given the valuation. I think you might get real plus 1 or 2 over the next 10 years, in my opinion, if you look at history. The current valuation indicates the long-term returns are going to be pedestrian at best. So if you think that and you're a long-term investor, then you should asset allocate accordingly. But it's very hard to be both a long-term and a short-term investor. So the hedge funds are much better than I am at trying to work out what's going to happen in the next 3 hours and 3 days. And I wouldn't manage. I just don't manage money on that. And private equity simply doesn't manage money on that basis. And I know it's almost like an enigma, private equity and non-public markets, private market stuff. But they simply do not look at that type of short-term instrument in order to manage things.
I'm curious, do you get questions like that from your own investors, though, about, are they concerned about those risks and the sense that if they get pressure on other aspects of their investments, are they going to, be able to either get the return they want from the private equity fund they've invested in, or that they're going to want to pull funds?
We've just gone through a fundraising process and raised our largest and 10th fund, and the majority of investors just look through it. They're 10-year funds. I mean, what you do find is the people at the periphery who are dipping their toe into private equity, suddenly the denominator effect of plunging markets, and maybe the valuation's going up in private equity if they're performing well, suddenly they've got to lower their allocations to private equity. And so you do get this sort of consultants advising firms who are going into it relatively naively, just missing the allocation cycle. But, good investors in private equity look through it.
There is a relatively mature market in secondaries as well in terms of people buying stakes of people who've committed to long-term PE funds. So, yeah, I mean, I'd echo what you say. Most people going into private equity recognise that it's a long-term investment, long-term commitment. But yeah, there is a mechanism for trading out if you need to.
And that liquidity is really helpful.
Yeah.
Last question. Anyone have a question? Right here in front. Yeah, just the final question. Just here.
Thanks very much. I got a question for Charlie. You addressed that the quality and the overvaluation of the assets with entry at the beginning, which I was wondering is that means the bargaining power of the private equity industry is getting lower. You have less bargaining power for that, or is that influenced by the whole macro environment, which is in an adjustment period? Thanks a lot.
I think it is the macro period. There's a supply of capital. Effective QE, those means there's more capital. We haven't seen as much growth and opportunity to invest in as we have in terms of growth in capital. Therefore, there's a mismatch of supply and demand, and valuations have gone up. Hence, a touch on the liquidity cycle and how that's all going to play out, I don't know. But for the moment, these bits of volatility may help a bit, take a bit of heat out of that valuation. But there's still, more capital and opportunity.
Great. Well, that's all the time we have. Thank you very much, everyone, for coming to the panel. And thank the panelists.